What if I told you that some of the wealthiest people on the planet, billionaires worth tens of billions of dollars, pay almost nothing in income tax? Not because they're criminals, not because they're hiding in the shadows, but because they have mastered something that was never taught to you in school, never mentioned by your bank manager, and never discussed in any government financial education program. They have weaponized debt. Not the kind of debt, the kind that keeps you awake at 3 in the morning. Not credit cards, not payday loans, not personal loans you took to fix the boiler. A completely different kind of debt. Strategic, tax efficient, wealth multiplying. And once you understand the mechanics, the difference between your debt and their debt, you will never look at borrowing the same way again. There are two fundamentally different kinds of debt in this world, and they flow in opposite directions. The first type is consumption debt. This is the debt most people know. Car on finance, a holiday on a credit card, an overdraft to cover rent, personal loan to cover Christmas. You borrow money. You spend it on things that go down in value or disappear entirely. You pay it back with interest. At the end of the process, you have less money than you started with and nothing to show for it. This is the debt the financial industry wants you to have, because every pound you pay in interest is their profit. UK consumers owed £1.87 trillion in total debt as of 2024, including mortgages. The interest payments on personal consumer debt alone cost UK households billions of pounds every year, money that flows directly to banks and lenders. The second type is productive debt. This is what the wealthy use. You borrow money, but you borrow it to acquire an asset that generates income and appreciates in value. The debt is secured against the asset. The asset pays for itself. The interest is tax deductible. And while you are sleeping, the asset is compounding. Same instrument, completely different application, completely different outcome. Let me make this concrete. You identify a buy-to-let property worth £300,000. You have £60,000, a 20% deposit. You borrow the remaining £240,000 from a bank at a 4.5% interest rate. Your monthly interest cost, approximately £900. Your rental income, £1,400 per month. Your net cash flow before tax and expenses, £500 per month. But here is where it gets interesting. Over 10 years, at even modest property price growth, that property could be worth $450,000. You invested $60,000. You made a gain of $150,000 on someone else's money. The tenant paid the mortgage. The bank's money built your wealth. This is not illegal. This is not immoral. This is how it works. And it is taught in every business school, just not in your school. Now let me explain the most sophisticated wealth preservation strategy in the modern world. It is known in financial circles as the acquire, borrow, transfer strategy. And it is entirely legal. Step 1. Acquire. Wealthy individuals buy appreciating assets, shares in companies, real estate portfolios, fine art, timberland, stakes in private businesses. These assets grow in value year over year, but crucially, they do not trigger a tax event simply by growing. You only pay capital gains tax when you sell. So the wealthy do not sell. They hold, and they accumulate. Step 2. Borrow. When they need cash to fund a lifestyle, to invest in the next opportunity, to buy a yacht, they do not sell their assets. They borrow against them. They walk into a private bank and say, I have £50 million of assets. Lend me $10 million at 2% interest. The bank says yes, because the security is excellent. The key point, that £10 million in borrowing is not income. It is not taxable. The wealthy individual spends £10 million on whatever they choose and pays zero income tax on it. Elon Musk, Jeff Bezos, and Larry Ellison have all been documented using loans secured against their company shares to fund personal expenditure, allowing them to access billions in liquidity without triggering income tax or capital gains tax liabilities. Step 3. Transfer. This is where the strategy becomes truly extraordinary. In the United States, there is a tax provision called the step-up in basis. When a wealthy individual passes away, their heirs inherit their assets, but the cost basis for capital gains tax purposes resets to the current market value. The entire lifetime of unrealized gains, potentially billions of dollars of appreciation, is wiped from the tax calculation. The heirs inherit the asset and can sell it immediately with no capital gains tax on those historic gains. So the billionaire never pays income tax because they never receive taxable income. They never pay capital gains tax because they never sold the assets during their lifetime. And their heirs inherit a tax-clean fortune. 3 steps that explain why some of the world's richest dynasties compound across generations while ordinary families reset to zero with every generation. OPM, other people's money, the foundational principle of almost every significant fortune ever built. Think about how businesses actually scale. A property developer does not build one house with their own savings and wait 20 years to build the next one. They raise funds from investors. They secure development finance from banks. They pre-sell units to generate cash flow. They build an entire estate on other people's money. When it is done, they pay back the loans, return investor capital with profit, and keep the development margin, which they immediately deploy into the next project. This is not unique to property development. It is the fundamental mechanics of every bank, every private equity firm, every venture capital fund, every hedge fund, every real estate investment trust. The wealthy do not risk their own money to build wealth. They use their existing position, their credit rating, their relationships, their track record, their assets to access money at scale. Money that belongs to other people, banks, pension funds, institutional investors, sometimes government grants and subsidies. The entire private equity industry, worth over $12 trillion globally, is built on borrowed money. Private equity firms typically fund 60 to 70% of acquisition prices with debt. The returns they generate are amplified by leverage, and so are the management fees they collect. Here is another dimension of this that most people miss. Wealthy individuals and corporations can borrow money more cheaply than you can, because they are perceived as lower risk. A large corporation might borrow at 3%. They invest that money in assets or businesses generating 8%. The gap, 5%, is pure profit generated from borrowed money. At scale, this margin becomes enormous. A retail customer with a modest credit score might pay 18% on a credit card to borrow money that earns them nothing. They are on the wrong side of the same equation. This is why the rich get richer and the poor get poorer, not through moral superiority or harder work, but through access to fundamentally different financial instruments at fundamentally different price points. The use of debt as a tax minimization strategy is not just for individual billionaires. It is embedded in the operating model of the world's largest corporations. Here is how it works. A multinational company, let's say a tech giant, has subsidiaries in multiple countries. The parent company, based in a low-tax jurisdiction, lends money to its subsidiaries in high-tax countries. Those subsidiaries pay interest on the loans back to the parent. That interest is tax-deductible in the high-tax country, reducing the taxable profit there. Meanwhile, the interest received in the low-tax parent company is barely taxed. The result, profit is shifted from where it is earned Britain, France, Germany, to where it is barely taxed Ireland, Luxembourg, the Netherlands, the Cayman Islands. The debt between related companies is the pipe through which the profit flows. Google, Amazon, Facebook, and Apple have each faced investigations and settlements with European tax authorities for using intragroup financing and transfer pricing to shift profits out of high-tax jurisdictions. The amounts avoided run into tens of billions of pounds globally. This is called debt shifting or earnings stripping. It is legal in most jurisdictions, though regulators are slowly tightening the rules. The OECD has been working on international minimum tax agreements with limited success, precisely because the financial architecture that enables this was built by the same countries now trying to reform it. In the UK, HM Revenue and Customs has specific rules, the corporate interest restriction, that limit how much interest expense companies can deduct. But the rules are complex, full of carve-outs, and require significant resource to enforce against well-advised multinationals. Meanwhile, a small UK business owner asking HMRC for guidance on legitimate debt structuring might wait months for an answer. The rules apply to everyone. The ability to navigate them, to hire the advisors who understand every nuance, applies only to those who can afford it. Let us come back to the most accessible version of productive debt for ordinary people. Property. Property is the one asset class where banks will lend the average person significant multiples of their salary to acquire an appreciating, income-generating asset. This is remarkable when you think about it. Your bank will not lend you £300,000 to build a stock portfolio, but they will lend you that to buy a house. The question is, are you using that facility strategically? Most people in the UK use property leverage for their primary residence only, which is the least financially efficient use of property debt. Your home does not generate income, it generates lifestyle. The mortgage interest is not tax deductible. The appreciation is real but illiquid. You cannot spend it without selling or releasing equity. The wealthiest property investors use leverage differently. They buy income-generating properties, commercial, residential, mixed use. They use the rental income to service the debt. They refinance as values rise to release equity and repeat the cycle. They build portfolios, not single properties. A property investor who buys 10 properties worth £200,000 each, using 25% deposits and 75% mortgages, has £2 million of property for £500,000 of personal capital. If those properties appreciate by 20% over 5 years, the investor has made £400,000 in asset gains on a £500,000 outlay. That is an 80% return, powered by leverage. This is why the property-owning class compounds so rapidly. Not because property is uniquely magical, but because it is the one asset most people can access with substantial leverage, and very few people understand how to use that leverage strategically. Now let me be clear. I am not telling you to go out and borrow recklessly. Debt used unwisely destroys wealth faster than anything else. The point is not to borrow more. The point is to understand the purpose of every pound of debt you take on. Before you take on any form of debt, ask 3 questions. 1. Does this debt acquire an asset that generates income or appreciates in value? 2. Is the cost of this debt lower than the return the asset will generate? 3. Can I sustain this debt even if my income falls? If the answer to question 1 is no, it is consumption debt. Think very carefully before you take it. If the answer to all 3 is yes, it may be productive debt. And productive debt, used wisely, is how ordinary people access the same compounding mechanics the wealthy use. For most people, the first productive debt they will use is a mortgage to buy property. Before you access that, maximize tax-efficient savings. Use your ISA allowance. Build your deposit from after-tax income, because a larger deposit means a better interest rate and less debt cost. When you own a property that has appreciated, consider whether a remortgage or equity release can fund the deposit on a second property. Use debt the way the wealthy do, as a tool to acquire assets you could not otherwise afford to own. Not as a way to fund consumption you cannot otherwise afford to enjoy. The wealthy do not fear debt. They respect it, and they make it work for them. Now you know how. We have now looked at several separate pieces of the same puzzle. The 2 types of debt. The 3-step wealth preservation strategy. Other people's money. Corporate debt shifting. Real estate leverage. Put them together and what do you see? A coherent system. One that was not designed by accident. One that rewards those who understand it and penalizes those who do not. The wealthy have access to cheap debt, secured against appreciating assets, with interest that is tax deductible, generating returns that compound across generations. The system is designed to preserve and grow their wealth. Ordinary people have access to expensive consumer debt, secured against depreciating assets or nothing at all, with interest that is not deductible, generating returns for the lender. The system is designed to extract value from them. Reformers have proposed several changes. A mark-to-market tax on unrealized gains above a certain threshold. A minimum effective tax rate for high-net-worth individuals. Closing the step-up in basis loophole in the United States. Tighter limits on corporate interest deductions globally. Each of these proposals has been resisted vigorously by those who benefit from the current system. The lobbying is well-funded. The arguments are sophisticated. The revolving door between government and the financial sector keeps the rules favorable. This is not a conspiracy. It is a system. and systems can be changed, but only by people who understand how they work. The next time you hear someone say debt is bad, remember this: debt is a tool. Hammers are tools too. In skilled hands, a hammer builds a house. In unskilled hands, it breaks things. The wealthy learned how to use the hammer. They were taught young, by family, by advisors, by elite education. Nobody taught you. Until today. In the next chapter, we expose the housing scams that drain ordinary people, while making developers, freeholders, and institutional investors extraordinarily rich. Share this video. Someone in your world is about to take on the wrong kind of debt. They need to see this first. If this changed how you see money, subscribe to the Paper Trail, because the next chapter goes even deeper.